10-year Treasury yields extend the move higher, getting as high as 224 today, and then seeing a pullback after the FOMC announcement. Yields across the board were higher, more aggressively higher in the short end after the Fed raised rates today. The Fed raised rates 25 basis points, gave a little bit more of a hawkish statement than I think most were expecting. And then from Mr. Powell, we heard that price stability is going to be his focus, and the Fed may need to be more aggressive sooner than later if inflation continues to move at the pace that it has over the last several months. Now, what we saw here was a continued flattening of the yield curve. And what I mean by that was that the short end yields were moving up faster than the 10s and 30s, than the ones in the back, and actually starting to see the 7-year, 10-year spread invert. And we're seeing the 5-year, 10-year get very close to inversion, and the 2-year, 10-year at its lowest in over 2 years. So right now, that doesn't give a whole lot of hope and outlook for the economy if the yield curve is flat. Think of it this way: someone's willing to accept a 10-year yield for less than they would, say, a lower yield than they would for one of a shorter duration. So at this point, Fed has to be concerned with the flatness of the yield curve. But clearly, after one rate hike, they're not going to make any big knee-jerk reactions or announcement at this point. The Treasury curve will be something they'll keep an eye on, but clearly it's not the focus. The focus right now is going to be prices and price stability. And again, 10-year note yields, which moved as high as 224 today, backed off to end the session around 217. Now, what does this all mean for volatility? Well, if you check out that CVOL index over at cmegroup.com, you will notice that volatility has been elevated lately, but is starting to move lower. And today, after the Fed announcement came out, we saw volatility make another move lower after the event. A lot of that event risk that's priced in prior to the event, like FOMC or non-farm payroll, the second it comes out, the market absorbs it. They kind of start to reprice everything, and volatility moves lower. It's exactly what we saw today, but it does remain elevated and off the month lows. Lastly, let's look at what we have the rest of the week. Well, we have the claims number tomorrow. That's our in-the-moment look at the job market. It is expected to come in at about 220,000 new filings. That's higher than the Fed would like. They want to see that number get back south of 200,000, something that hasn't happened in quite some time. We also get some housing data and some manufacturing data, and then we get what we call FOMC +1, the day after the Fed meeting. What does the market do? The reactions we're seeing now, a lot of them are knee-jerk reactions to what the Fed said, covering of positions and whatnot, but it'll be interesting to see what happens once we have a day under our belt or a night under our belt with all this new information. Will Treasury yields move higher? Will they continue lower? And more importantly, what will the yield curve do? Will that continue to stay as flat, given the fact that we are anticipating yet another rate hike in May, possibly a 50, market right now pricing in about 40% odds of a 50 basis point rate hike at the May FOMC. It'll be interesting to see what happens. Clearly, we have some data to absorb, but before we get there, more inflation, more jobs, more economic numbers, and whatnot. The other thing the Fed has to be concerned about is growth. The growth numbers, obviously, for first quarter looking very low. The Fed may be looking past that and looking more at the rest of the year. They're anticipating growth for the year to be about 2.5%. So that'll be well off expectations for what we're reading right now for first quarter. But that could be one reason why Treasury yields aren't moving higher as quickly as many may have thought. So to start, our FOMC comes and goes. 10-year note Treasury yields hit a new high of the move, up as high as 224, but pull back to 217, and the yield curve continues to remain eerily flat after Mr. Powell talks and is going to be focusing on price stability as the Fed looks to raise rates continuously throughout 2022.